By the end of 2024, the US dollar became the top performing currency on a Forex among more than 30 of the most liquid currencies. Overall, American years and events remained one of the primary forces shaping global market sentiment. Exceptional economic resilience, rapid progress in artificial intelligence, and of course Donald Trump's victory in the presidential election. Thanks to the new old president, the US dollar demonstrated its best performance since 2015. Apparently, this trend will spread into 2025 on condition the US economy stays healthy. So don't forget to keep an eye on economic statistics and their impact on the currency trends. You're watching the Traders Calendar for January 7. Inflation is one of the main indicators of a country's economic health. Ideally, it should grow by 2% annually. The central bank adjusts its key interest rate to regulate inflation, making CPI reports crucial for markets. A rise in inflation is commonly bullish to the currency. As the ECB plans further rate cuts, a potential increase in inflation to 2.4% could make policymakers introduce hawkish adjustments to the agenda. For the euro, this could trigger growth, though short-lived. The Canadian dollar may struggle to strengthen in the coming weeks. Trump's plans to impose new tariffs on a trade with the United States' northern neighbor could push Canada's economy into a severe crisis, especially since Canada's trade balance is much smaller than that of the United States. Notably, about 80% of Canadian exports are meant for the US market. Forecasts predicted that export volumes in November could shrink again, affecting the Canadian dollar. The US trade balance is also expected to decline to around $264 billion. October's figure already fell to its lowest point in 4 months, so another drop would confirm a downtrend, putting extra pressure on the US dollar. While trade balance data reflects past performance, the PMI acts as a forward-looking indicator. It measures multiple economic factors: commodity inventories, labor market conditions, demand, and inflation. If the index drops to 52 points, it could weaken the Canadian dollar. At the same time, the Institute for Supply Management will release its services sector activity report. The index is expected to climb to 54 points, signaling growth for the US dollar. Interestingly, the S&P Global's forecast for the same indicator is even higher, around 58.5. It means that the US services sector is performing well, supporting the dollar's bullish momentum. One key component of the business activity index is the employment rate. Forecasts predict that the services employment index will rise from 51 to 52 in December. Markets will closely watch this data ahead of the US non-farm payrolls, potentially boosting the US dollar. A series of labor market reports will begin on Tuesday, leading up to the highly anticipated non-farm payrolls. The first report will cover job openings and layoffs for November. While these numbers are technically reflected in the November non-farm payrolls, the consensus predicts a drop of 54,000 job openings. This contradicts the rise in a new job during the same period, suggesting a possible downward revision of the non-farm payroll data. Typically, such revisions are bearish for the US dollar. Conversely, the dollar's decline could be offset by layoff data from the US Labor Department. Forecasts indicate that layoffs will decrease by 16,000 to around 3.31 million. Lower layoffs suggest a strong labor market, which could stabilize or even strengthen the US dollar, if not immediately, then by increasing volatility. The next trader calendar will be released on a Wednesday, January 8th. We wish you profitable trading and see you soon.